Over the past 10 years, exchange-traded funds have become the simplest, cheapest, and most popular way to get started in investing. But for many people, exchange-traded funds remain something of a mystery. So in this video, I'm going to talk you through what an exchange-traded fund is, how it works, and why it is such a good way to get started in investing for your everyday person. G'day there, my name is Phil McGilvray. I'm a financial coach, financial well-being consultant, and founder of the Money Boss movement, where we make practical, life-changing financial education both understandable and accessible for everyday people. Okay, so we all know that we should invest, but trying to work out what to invest in and how to get started can be very overwhelming. And unfortunately, many people end up putting investing in the too hard basket, which costs them potential years of compounding interest returns. So please do not let this be you. Investing does not need to be difficult. And as I will show you in this video, using exchange-traded funds or ETFs is a great way to get started. So let's have a look at what an exchange-traded fund is. An exchange-traded fund is an investment fund that bundles together a wide range of different investments into one product, allowing you to own all of those investments with just one purchase. Now, I like to think of an exchange-traded fund like a chocolate cake. Now, you can see in the middle of the screen here, we have this beautiful looking chocolate cake, and around the outside, we have all the ingredients that go into making that chocolate cake. We've got the cocoa, we've got the sugar, we've got the flour, we've got the water, the butter, and the eggs. They're all there. And to make this chocolate cake, I then need to put all of those ingredients together in the right proportions to make that chocolate cake. And that's going to take some time and some expertise to make that happen. So if we have a look here, we can say, well, an exchange-traded fund is like buying a completed chocolate cake. Sure, we could go and buy all the ingredients and we could make the cake ourselves, or we could just go to the supermarket and we could buy a completed chocolate cake where someone else has worked out, they've bought all the ingredients, they've worked out what proportion those ingredients need to go into that cake, they've worked out how long it needs to be cooked for and so on. They've done all the hard work. But if I can just buy that cake as a completed thing, then I can go, great, I can just really then sit back and enjoy it. Now, a chocolate cake, an exchange-traded fund, is instead of buying ingredients for a cake, you are now buying stocks in many different companies. So with one investment, your money can be spread across literally hundreds of companies all over the world. And this is what an exchange-traded fund will do. Instead of you having to go and do your research and work out, okay, well, which stocks am I going to buy? And, I'm identifying, well, which are the good ones, which are the bad ones, etc., and getting the right mix of those. Instead of you having to do that, the exchange-traded fund goes and does that for you. So on the left-hand side here, you can see we've got a whole big list of companies. These are the top 20 companies on the Australian share market, so the biggest companies in Australia. You can see down the right-hand side the proportion that they make up, that top 20. So this is like, figuring out, well, 2 cups of sugar and 1 cup of flour and all that sort of thing. This is exactly the same thing. These proportions have already been worked out by the fund manager that puts the exchange-traded fund together, so you do not need to worry about it. Now, there are 2 types of exchange-traded funds that we need to know about. The first one is what's called an actively managed exchange-traded fund. And the actively managed exchange-traded fund is where they've got a portfolio manager that actually picks and chooses which companies are going to be in this exchange-traded fund. And often with these actively managed funds, each exchange-traded fund has a theme. So for instance, it might be a theme where it's buying all companies to do with AI technology, or it might be a sustainability fund, or it might be a cybersecurity fund where they've gone out and found the biggest or the best companies in the world to put into their fund, so you can invest in line with the theme. Now, understand though that they have professional fund managers who pick and choose shares that go into this, which is why it's called actively managed. Now, the pros of investing in a fund like this is that you can invest in themes you're interested in. You can also get access to some of the biggest and best companies around the world. The cons are, because you've got an active fund manager in there picking and choosing which companies to include in the exchange-traded fund, the fees can sometimes be quite a bit higher. And the second thing is that There's been a lot of research around the whole idea of actively managing an investment, and a lot of the research shows that active investing doesn't actually perform better than if you just invested in an index of a mixed funds where no one's actually picking and choosing. It's just the top 50 or the top 100 or the top 500 shares in a particular country. So there's not actually a lot of evidence that you're better off paying the extra fees to invest in these things. So that's an actively managed exchange traded fund. If we have a look at passive exchange traded funds, and these are by far my preferred method of getting started with exchange traded funds, and certainly the rest of this presentation will be focused on passive exchange traded funds. But passive portfolio managers, they do not pick and choose shares. They do not have expensive fund managers that are doing a whole bunch of research to figure out which are the best ones. All they do instead is they track an index. So the exchange traded fund just tracks an index. Now I'll explain this in a little bit more detail in a moment, but understand that all they're trying to do is copy what the index is doing. So you might have heard of, in Australia, you might have heard of the All Ordinaries Index, which is the top 500 shares in Australia. You might have heard the NASDAQ, which is the top 100 tech shares in the US. You might have looked at the Dow Jones, which is the top 30 companies in the US, or the S&P 500, which is the top 500 shares in the US. All of these companies are there simply because of their size, and so they are there as the biggest companies in the world. No one's picked and chosen them to be in that index. They just are because of their size. So when you've got an index fund, what an index fund is just literally replicating the shares that are made up in that index. So the pros of investing in a passive exchange traded fund is that the fees can be very, very low. And that is very powerful. That is very, very important to consider. The second thing is the passive funds have proven to provide better long-term returns. The cons are that as we quickly go back here, if you have a look at this index fund here, you can see that 12.84% of this index fund is invested in Commonwealth Bank. 11.3% is invested in BHP. So whenever you invest in an index fund, it'll invest your money in direct proportion to what they make up that index, which may be good, it may be bad, but sometimes some of these big, heavy companies can get very overvalued, and then when they fall in value, it pulls the rest of that index down with them. So that is a downside to it, but it's not a very big downside. So if we come back to the chocolate cake example now, think of the index, the overall index. So that might be the All Ordinaries Index, it might be the NASDAQ, it might be the Dow Jones, it might be the Nikkei 225 in Japan. Think about all these indexes around the world as the big cake. And then think about an exchange traded fund as a cupcake that is made with the same mixture, but it's just a much smaller version. This means that you have exactly the same ingredients, they're there in the same ratios, it should taste exactly the same, it's just a much smaller version of that overall big cake. That is what an index fund is, it's just a lot smaller. So let's look at an example of this. The Vanguard Australian Share Fund, so an exchange traded fund, replicates the ASX, Australian Stock Exchange, top 300 shares. So what that means is that the Vanguard Australian Share Fund holds the top 300 shares in exact same proportion to what they're held in the ASX 300. Now, of course, they're only just a small subset of that. So you've got the big cake, which is the ASX 300, and then you've got the Vanguard Australian Share Funds, which is the cupcake, all the same ingredients in exactly the same proportion. It's just smaller. And many of the companies in this ASX 300 are household Australian names, companies that you would use every single day. So let's look at another example of this. This is the BlackRock S&P 500 exchange traded fund. The big chocolate cake for this fund is the S&P 500, which is the top 500 companies in the US. You can see on the left-hand side here, we've got Microsoft, Apple, Nvidia, Amazon, and so on. And then the cupcake is the BlackRock fund, which again holds all of those shares in the exact same proportions. It's just smaller. Its goal is to replicate exactly what happens in the overall index. So the question now is, okay, exchange traded funds look like a good investment that will give me instant diversification, access to companies all over the world, but how do I actually get started investing in exchange traded funds? Well, there are three ways to invest in exchange traded funds. The first one is that we can invest through a broking account, which we could set up with our bank. The second way is we could set up a broking account with an independent broker. And the third way is that we could use some kind of investment platform. So if we have a look here, all of the major banks in Australia have their own broking account. So if you bank with Commonwealth, Westpac, National Australia Bank, you'll be able to find on your website access to a broking account. Now, if you're already set up with that bank, it's going to be very easy for you to set up a broking account so that you could get started investing today. The second way to do this is to have an independent broking platform. So these are they're non-bank platforms where you can just set up a broking account. You transfer money into an account you set up with that broking account, and then you can buy and sell exchange traded funds from that platform. So some of the big ones in Australia are CMC Markets, IG Markets, Self Wealth, Interactive Brokers, and eToro. There are plenty of others, but these are the best known ones on the Australian market. And I will say that buying and selling exchange traded funds through these platforms is no harder than using eBay. Again, sometimes we get blocks about, oh, how hard is this going to be? It is no harder than using eBay once you've got it set up. And the third way to invest in exchange traded funds is to invest through an investment platform. Now, there's plenty of these out there, but Vanguard is easily one of the biggest in the world. It is the biggest index fund manager in the world, and you can set up auto invest through Vanguard. It's a fantastic platform. The only downside to it is that it only has the Vanguard exchange traded funds on that platform. On the right-hand side, you've got Raise, which is a nifty app that I use to set all my kids up with their investments. Again, you can set up auto invest. It also has this other little feature where every time you do a transaction, it'll round that transaction up to the nearest dollar and take the difference and transfer it to your Raise account and invest it in your exchange traded funds. Both of these platforms are fantastic places to get started and very, very easy to set up. Both of them take 10 to 15 minutes to get set up and you're off and going. So let's have a look now at the pros and cons of investing in exchange traded funds, starting with the pros. So the first pro is that you can get started with as little as $100. In fact, with Raise, I think it's as little as $10, but because of the fees, you don't want to start too small. There are lower fees with the exchange traded funds, especially the index funds, very, very low fees, which means that most of your money is left there to compound over time. And I can tell you the impact of fees on your portfolio is huge when you're thinking 10, 20, 30 years down the track. You get instant diversification. That's one of the rules of investing, is that you should be diversified, and exchange traded funds allows you to do that immediately. It's easy to set up and use, and you can set up your portfolio in as little as 15 minutes. So let's have a look at the cons. Firstly, there is some brokerage sometimes with exchange traded funds to be able to buy and sell, but often they're very, very low. Not all platforms will support auto investing, and I truly believe that one of the best ways to build wealth over time is to set up dollar cost averaging, which is investing the same amount of money every single month, regardless of where the market's at. And the best way to do this is to set it up on automatic pilot so that every month money is taken out of your bank account and invested. So you want to go with some kind of platform that's going to allow you to do that. The other thing is, and this is really nothing to do with exchange traded funds, but whenever you're investing in shares or anything like that, you do need to be thinking long term, at least sort of 7 to 10 years, just due to the fluctuations. Now, if this has been helpful to you so far, can I please ask you to click the like button down below and to subscribe, because that helps my channel reach more people. And as you know, I am on a mission to make practical, life-changing financial education both understandable and accessible for everyday people. So please click the like so that this video can reach more people. So to finish off, let's get a quick word from the world's best investor, and that is Warren Buffett, of course. His advice is for small investors to put their dough into index tracking funds because of their broad diversification and low cost. And he also says that a low-cost index fund is going to beat the majority of amateur managed money and professional managed money. 85% of Australian-based fund managers, professional fund managers, cannot outperform the index over 15 years. And in the US, it's actually 93% of professional fund managers cannot outperform just investing in an index. So why would you do anything else? So there you go. That's a very quick overview of exchange traded funds. I am really hoping that you now have a good understanding of what exchange traded funds are and how they work. So if you are new to investing, if you have small amounts of money to invest, if you want to keep your investing really simple, or you simply just don't have the time to do the research to invest, then exchange traded funds are absolutely the place to start. Now, if you are looking to take better control of your finances, to get out of debt, to consistently save more money, to make your life goals a reality, to get started investing, then can I invite you to click the subscribe button down below, because every Monday and Friday, we release videos with practical, life-changing financial education. In next week's video, we are going to look at, well, how do I pick which exchange traded fund to invest in? I hope this has been helpful. I look forward to seeing you in the next video, and have a great day.